Hello and welcome to our HHM webinar about the One Big Beautiful Bill, where we talk about changes that we think are applicable to our car dealer clients and what it means for you. My name is Jacob Pardue. I'm a manager in our automotive service department, and I'm going to let my colleagues introduce themselves.
Brad Culbreth, senior manager, also in our dealership services group.
I'm Lee Ferguson. I'm a partner in the dealership services group.
Awesome, guys. So this is the second segment of our webinar here. And we're going to talk a little bit about capital investments and the tax benefits that the One Big Beautiful Bill kind of brings into play for our dealers. And so let's just kind of get right to it. The big piece that everyone is really excited about is the reinstatement of 100% bonus depreciation. So you guys care to talk a little bit about that and kind of what that means?
Yeah, well, you said it. 100% bonus depreciation is back. Previously, it was scheduled to only be 40% this year, and it was phasing down to 20 next year and 0 after that. So now 100% is back, and it's a permanent law. It's not one that's set to sunset later on. So what that means is any eligible property, equipment, lifts, tools, things like that, are going to be eligible to take 100% of that cost as a depreciation deduction in year one, the year you purchase.
Awesome. And so one of the things that potentially hindered bonus depreciation in the past was Section 163J, which comes into play with high gross receipt taxpayers like car dealerships. Lee, can you just give a brief kind of overview of 163J, how it interplays with bonus, and what the old law looks like versus now with the new bill changes and how it's beneficial to car dealers?
Yeah, so 163J, essentially, it limits the amount of interest expense you could take in any given year. It limits it to 30% of your adjusted taxable income, okay? So for tax years after 2022, or during 2022, your adjusted taxable income is basically your taxable income without interest, adjusted for items like, interest expenses is added back to that, so it's without interest. And if you had any floor plan financing interest, that is a reduction, because floor plan financing interest has its own exception to this limitation. It's not subject to the same limitation as the other interest. So from 2022 and through 2024, we have not had an add back to this adjusted taxable income of depreciation and amortization. And that's hit a lot of our car dealers pretty hard. And the reason it hits the car dealers, even though they have this floor plan exception, if their total interest, including the floor plan interest expense, exceeds that 30% of adjusted taxable income, those dealers are not able to claim bonus depreciation in that year. So that's why it's been so huge, and it's impacted a lot of our dealership clients to take bonus depreciation. So, we've used other methods to kind of offset that. Maybe we could use Section 179 to fully expense the assets. But under the new bill, those are being added back. So starting in tax year 2025, we're going to be able to add that depreciation and amortization expense back to that adjusted taxable income. So that's going to give you a higher adjusted taxable income, which should allow you to deduct more interest.
So Lee, we were even seeing in previous tax years, 22 onward, dealers that were profitable, but the profits weren't high enough to where that 30% of ATI could cover all the interest expense. And so even though they were making money, they still weren't able to take bonus depreciation, correct?
Yeah, I mean, and that's the thing. It did not include, for tax years 22 through 24, it did not include those adjustments back for depreciation and amortization. So if you put a lot of assets in service, that's going to reduce your taxable income. And since there was no add back in those years, a lot of your interest could be would be limited. It may limit some of your interest, but it would also, the bigger point is, it would disallow that your ability to take bonus on that dealership.
It's a pretty big deal to be able to have that back.
Yes, it's a very big deal.
So, and you mentioned 179 earlier. Can you kind of talk about any changes to 179, both you guys, and how that has been beefed up?
Yeah, so they increased. So Section 179 is another method of you being able to expense the cost of an asset in year one. It speed up the cost recovery of an asset. So they increased the dollar amount that you can expense in any year to $2.5 million. It was previously $1.4 million, correct? I believe last year. So about 1.4, I think. So now it's $2.5 million you can expense, and then there are phase outs for how much you can take if total 179 eligible purchases was $4 million or more. So starting at $4 million of acquisitions, it starts to phase out how much of that 179 you can take. And so in previous years, 179 was big because if you were not able to take bonus, as Lee mentioned, you may still be able to take 179 and get some of the cost back on those purchases you made during the year. And then additionally, a big thing with 179 is depending on what state that you file in, some states disallow bonus. They don't follow federal treatment on bonus, but they do allow 179. So depending on which state you're in, 179 may be more important to you than bonus depreciation.
Yeah, I mean, these changes that we're talking about, we deal with them all the time, but the dealers may not particularly understand how important these items are and how they impact their tax liability.
Sure.
So that's one thing that I think, I hope some dealers can get their arms wrapped around. The bonus 163J interplay, and just that 163J limitation, or at least to some degree to understand, hey, how much extra am I going to have to owe or not owe in this case, since this is obviously very beneficial tax. The tax law changes for dealers, but yeah, I think it's very important and probably one of the most important parts of the bill for dealers this year.
Absolutely. And in our previous segment, we kind of talked about benefits for consumers, and one of the things we touched on were EV vehicle tax credits. Can we touch base real quick on the charging infrastructure tax credits and the changes that are made to that and how that's going to play going forward?
Yeah, so the alternative fuel refueling tax credit, I believe, it's something along those lines, but basically EV charging stations were, what we've mostly seen these tax credits be taken on. There's been some changes to these being able to take this credit over the years. It has to be now in a low income community or in a rural type area in order to even qualify for these credits, but still a lot of dealers do qualify. There's also been in the past couple of years, there's also been additional requirements related to apprenticeship and some of the other kind of wage type requirements related to this tax credit. So a lot of our dealer clients have not been able to take the full 30% credit lately. And a lot of them, this credit has been kind of relegated to a 6% credit of the total cost of those EV charging stations. So that's kind of how it's been prior to this law, and it's going to continue that way after this law. There was really no major changes into the qualifications of it, but there is, you could now, that credit will completely expire after 6/30/26. So that's next year. After June 30th of next year, that credit's gone. So you need to keep that in mind if you're, if you're planning an installation of this. Are you going to get it in before that, before you could take this credit? And, even if you can't, I mean, it's a 6% credit. Is that really going to be a big deal? Or are you able to justify that full 30% credit is a lot of times what we ask. You got to get a lot of that information from the contractor who's building that charging station.
So similar to the consumer credits, though, this is expiring. It just has a slightly later date.
Yeah, slightly later date.
Okay. So to kind of summarize on capital investments for dealerships, what are some planning strategies that you would recommend implementing and some things that you'd want dealers to look out for?
Well, if you're planning some sort of some larger purchases, service expansion, maybe you're building a new dealership building, something like that. Any kind of major investment like that. It's a good time. It's a better time this year or next year than previously because we can recoup some of that cost with depreciation. But also a lot of this, it becomes a little bit more important to do something like a cost segregation study on some of those real estate builds, purchases, anything like that, because we have the 100% bonus and instead of a 40 and a 20% coming up bonus depreciation. So the benefit of having something done like that, a cost segregation study, is greater now than it was before. So I would definitely consider that. Talk with your tax professional, tax advisor on that and whether that's going to make a difference. But I would imagine, if you're doing large real estate purchases, construction projects, there's likely going to be significant benefit to having a study like that performed to capture all these depreciation benefits.
Right. Yeah. I mean, I agree. That's going to be a major and the tax savings from cost segregation studies like that could just be massive.
Yeah.
I mean, it could be hundreds of thousands to even millions of dollars of additional deductions in the first year. So that those cost segregation studies are definitely something to consider.
Mm-hmm.
Obviously, you're going to buy equipment if you need it, not necessarily. You're not going to go out there to save tax money. So
Sure.
That's always something to consider. Is because you're getting maybe a 30 to 40% savings off of every dollar you spend. So it's I always tell clients if you need the equipment or if you're going to need it in the future, near future, go ahead and buy it, but don't just buy it if you don't need it, which I don't think most do, but just something to consider.
Don't throw a dollar after
Yeah.
30 cents.
Yeah.
That's good advice. Well, I think that wraps up everything for capital improvements. If you guys have any questions, feel free to reach out to us at HHM CPAs, and thank you for watching.
So we got
Boom.
30 minutes, so yeah.
How much?